All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, the main man over there at Madison Trading House, Mike Patton. Good morning, Mike. How are you doing?
I'm doing great, Sip, and good morning, everyone.
Today is episode 17, July 20th. We're pretty quiet on the economic front, or at least
Yeah.
economic news, but we are in the thick of earnings news. And I know that we'll be covering that a little bit later specifically. But I think you wanted to start with some of the energy news that's happening over in Europe. What are you seeing on that end?
All right. So, great topic to discuss right now. So, folks, all of you who've been following us for a while, you know that we've been talking a lot about um, oil, energy in general. Just to kind of give a quick context. So, we, of course, have the conflict in Ukraine, which has had a tremendous impact on energy prices across the globe. It's a combination of direct disruptions and interruptions due to the conflict itself, but also to a much larger extent, at least at this point, to the sanctions and other maneuvers that have been made by different political powers since then. So, one of the big things that came up was natural gas. Now, uh, Europe is heavily dependent, massively dependent on natural gas from Russia, and that is a fact. And Germany, in particular, I believe 40% of their natural gas, and I believe their energies in general, are coming from Russia. So right now, Gazprom, which is the Russian state-owned natural gas company, which supplies natural gas to Germany as well as other places in Europe through what's called the Nord Stream 1 pipeline. Basically, that pipeline is under maintenance right now, and there's been a whole backstory in this. I'm not going to get into it. It's a lot. But the point is this: that natural gas supply has been cut down. And as a result, especially in places like Germany, people are having to cut back on their consumption of things like, hot water. They have to turn the thermostats down, etc. And the big fear is right now it's summer, and fortunately it's hot. So therefore, the need for heating the home is not so much of an issue. It's more like cooling, but you still need power. And the bottom line is they're having to cut back on a lot of things. And of course, people are not happy. Plus, the prices are sky high. Now, they've been importing liquefied natural gas from the United States as a way to kind of bolster and try to supplement, but we can't give them enough. There's no way we could supply enough natural gas in liquefied form to replace what Russia's giving to Europe. So the bottom line is it is a disaster, and to say the least, this is a really bad thing. And if it continues this way, it's just going to end up being a massive disaster. Sorry, folks. I forgot to turn my phone off. It's going to be even more of a massive disaster when we get down to when we get later in the year. I mean, especially wintertime. I mean, it's going to be crazy. So the Europeans are scared, and now that Gazprom, in Russia, have declared a force majeure, which basically means they're saying that there's some natural things that have happened that are beyond our control, and that we can't guarantee supply of natural gas. So obviously, this is not, they're not telling the whole truth. I mean, yeah, there's a little bit of that, but the reality is it's obviously a tactical move against Europe because the Europeans have been sanctioning the Russians. Okay, so they say, all right, fine, we'll do tit for tat. You do this, here's what we'll do. So the Europeans say, hey, we're going to get off for natural gas, but we're going to try to control the prices, and we're going to try to put a price cap on oil and natural gas. And the Russians say, okay, well, we'll just cut back the supply. We can't do anything about it. I mean, what can we do? So this is, I mean, it's I'm laughing at it not because it's funny in that sense, but it is amusing that this is exactly what we would expect to happen. And I just really don't get, when it comes to world governments, especially in Europe. I don't understand why, if you're that dependent on someone, why would you keep playing that card? I mean, why wouldn't you go some other direction, do something else? Do not mess with the one thing that you can't mess with. I mean, if you're completely dependent on Russia, I mean, it is what it is. Like you can't get around it. So in short, that's a bad situation for Europe. They're going to have to come up with a better solution diplomatically to deal with this, because as of right now, this hard line stance a lot of these guys are taking is just decimating them. And Russia basically is left in the power position where they have the ability to literally cut off the supply, and it means it's going to hurt Russia, but it's going to hurt Europe vastly more. So I think that right now that's the biggest single development. And also, folks, keep in mind that if natural gas supplies are cut off or dramatically reduced, and right now they are dramatically reduced, that also bleeds off into the economy. Germany is Europe's largest economy by far. It is the powerhouse of Europe. And if they're struggling, all of Europe is struggling. There's no way around it. So um, basically, this has to resolve. Energy is the underpinning of all of our civilization globally. I mean, you won't have modern civilizations without ample, cheap energy. So this move is exactly what I expected, exactly what a lot of people expected to happen. And now it's just a matter of seeing how they can maneuver their way out of this, but it's not looking that good.
Yeah, and it's probably leading to some flight to quality in a sense of people that might have been investing in Europe heading over to the US, and because we are slowly starting to come up with some better solutions, but we don't have the US doesn't have that reliance on natural gas. Is
Not at
that
all.
correct?
Not
Okay.
at all. I mean, and this goes into the next topic I was going to go over. But yeah, we're not dependent on this. We're literally shipping out excess supply. I mean, our country is in fantastic shape if we take advantage of our resources, but that's the next topic.
Right. And so that one is basically, well, the headline last week was President Joe Biden
Mm,
in Saudi Arabia and
yep.
some fist bump drama, right? There was
Yeah.
something around that, but essentially because he went to the Arab countries,
Mhm.
everyone's looking at an oil solution, right? And
Yep.
so what ended up happening?
Well, it was a huge dud. I mean, just to say it bluntly, I mean, when there have been few times I've seen anything of this magnitude where people met and literally nothing came out of it except a few photo ops, and that was it. I mean, basically, President Biden walked into there and said, "Hey, we're not coming here to talk about oil." I mean, that's what they said in the press. Oh, we're not here to talk about oil. We're here to talk about human rights. Okay. Well, then they get there, and then right away we're trying to push them on human rights things, and they just literally throw right back at us anything that they can point out. That and the truth is, I read the exchange. I'm like, yeah, they had a point. There was too many things they could point out to us, and the reality is our country basically has been very supportive of their regime for a long time. So it's kind of weird to come out now and say, "Oh, we're really concerned about all this human rights stuff." It's like, well, where was that before? I mean, we knew they were the same people back then as they are now. So in short, basically they called us out on our own BS. They really pulled that card out and said, "Dude, don't even go here." And basically they just shut that argument down. Then we start asking about oil. Now, the United States is truly capable of full energy independence. We are one of the few countries in the world who can do that. And ironically, Russia is another one that can do that too. In fact, Russia is more energy independent than us because they're a net exporter, whereas us, we could be a net exporter. We have been in recent history, very recent history, within the last only a few years ago, we were net energy exporters of oil. But as basically policies and agendas have come about, and people want to cut back on oil production here and et cetera. Well, it all sounds good on paper, but again, one of the things that always amazes me about modern civilization in the West is that people just don't seem to get where all of this comes from. Like, you can't have Western civilization without cheap, ample, easy to get energy. If you don't have that, there is no civilization at all. So, if we have energy independence here, we've got our own oil, we can pump more of it if we want. I get the environmental concerns, etc. But when it comes to CO2 and carbon emissions, it doesn't matter where the oil comes from. If you burn it, you burn it. So the point is, unless we really have some dramatically important reason why we need to get more oil from Saudi Arabia instead of getting it from our own shores, doesn't make sense. And the Japanese called us out on this years ago. They were like, "We don't get it. Why are you guys?" I mean, because Japan doesn't have a lot of natural resources, and they're just scratching their heads like, "What's wrong with you guys? Like, why are you making yourselves more dependent on other people that you claim you don't like and you don't agree with?" but you keep buying their stuff when you don't have to. Now Europe doesn't have a choice; they have to buy somewhere. At least a lot of Europe does. But we do have a choice, and my personal opinion is that we should pump more oil here to mitigate that problem. But as it stands now, we're taking out of our own strategic petroleum reserves and giving it to China, giving it to Europe, and it's like, what are we doing? Like, who comes up with these policies? But that's
And
where we are
so
now.
is oil kind of just hovering at that $100 a
Yeah,
barrel level, like, a couple
yeah.
points up, couple points down?
Yeah, so we dropped down to $90. When they were, I believe a lot of people were literally expecting that when Biden went over to Saudi Arabia, he was going to convince them to raise their oil production. Now, just to be clear, Saudi Arabia can raise their oil production. That is in their capacity to do so. The reason they're not doing it is because they're part of OPEC and they've already made a decision that they weren't going to do that. So they're not going to go against their primary allies, which is OPEC, to basically make us feel better. I mean, they probably pointed the same thing out that I just did. That, hey, guys, if you want more oil, just pump your own. Why are you asking us for it? So in short, we got nothing out of that, and oil prices rebounded right back up to 100 after that. So we're hovering around 100 once again, and that's again why I keep saying for this year, almost certainly we're going to stay around $100 a barrel. But also now that we know the Saudis are not going to play ball, and now that we know that the Russians are getting more aggressive in their energy policy towards Europe, where at first they were pretty congenial and like, yeah, we'll just keep honoring our contracts, et cetera. But as more and more pressure is on them, sanctions are on them, et cetera, they're just, I mean, they're literally just following right in line and say, okay, well, then we're going to do the same thing. Now, whether that's right or wrong doesn't matter. It is what it is. So oil will most likely stay supported. But that's the energy sector is really where most of this market movement and a lot of stuff is coming from, other than, of course, Fed related stuff like, for inflation. But a lot of the inflation issues that we're seeing are direct consequences of high energy prices too. So it's all hand in hand.
Yeah, and like we started the show off, it's not a economic heavy news week, so we're looking at
No.
earnings. So the inflation stuff isn't scaring us this week. The market's in full rebound mode here,
Yep.
primarily driven by earnings.
Yep.
But real quick, let some of the reports that we are looking forward to this week. It looks like the Philly Fed manufacturing, unemployment, flash services PMI, all those really I don't think are huge market movers.
Well, they can be, but I think in the current context, I mean, I should still mention China is still a big focus. I've mentioned this a lot of times that the biggest drain on oil prices right now is Chinese demand being pushed back because of their COVID lockdowns, and they're continuing. They're definitely not keeping this zero COVID policy working as well as they want it to, and as a result, they see more outbreaks, etc, and that means that they continue to lock down. So that's going to keep putting downward pressure on oil prices. But like I said, the Saudi part was just, if they up their production, then that should have pushed oil prices down. But since that's not going to happen, then that left oil prices back towards 100. So with these data coming out this week, I mean, the truth is it could affect us because if we see the unemployment is not moving in a direction everyone wants, which ironically is they want more unemployment, but if employment seems to be stagnating, even though in principle lower unemployment is a good number, in the context of what the Fed is trying to accomplish, it's not. So the markets may interpret a good unemployment number as a bad thing for the economy, because that basically says that inflation will probably be more pronounced, or at least if they interpret it that way, which I think they will. And as far as manufacturing, it could be a big number if it's a big surprise, sure. But if it's within the boundaries of what people expect, then I don't think there's going to be much of an impact. Everyone's looking for what the Fed's going to do in about 7 days. They have to decide. I think it's 7 days from now. They have to decide if they're going to raise by, three, 75
75 or
basis points or
100
whatever.
basically,
Yeah,
right?
basically. Yeah, and then the ECB, I didn't mention this, but the European Central Bank does have their meeting tomorrow, the 21st, and even though that's overseas, I do think that's going to have more of an impact on the markets than our own domestic data, mainly because with the current circumstances that we're dealing with globally, if whatever happens in Europe basically should be some sort of indication of what the global economy is looking like. And if Europe basically is making decisions that look like they're in panic mode or things are not going too well, which I think they probably will, then that will probably bleed over into our markets too. So in other words, if we see Europe make a unusually high rate hike or something like that, then that would basically suggest that the U.S. is going to do the same thing. Because usually the bigger central banks tend to work coordinated with each other to try to keep things stable. So I think we're going to be looking for that as a kind of indication of where we might go. Um, but we'll see. But I think that's going to have more impact tomorrow. So I will definitely be watching that and seeing if the numbers that come out for us look good, bad, or none of the above. And if
I
they look neutral, then we'll probably be fine.
I feel like with the recent market rally, it might help the Fed make a more, I don't know, tame decision, right? If the market's rallying, maybe they don't want to go a whole 100 points.
I'm going to disagree on that one. I do. I think that they are going to act more aggressively anytime they think they can at this point. And the rally we're seeing now, I mean, it's there, it's something, but it's not likely to be long lived. I mean, just because the circumstances we're in right now, they don't really lend us to like, oh, the market's going to do really well right now. I mean, there's just not that much good news out there. So we're going to see some. Now, the earnings are good. I will give it that. The bank earnings have been good. So we are seeing some better numbers than what were expected for a lot of companies. But I don't think that necessarily changes everything because we still have to think about, all right, well, that's great for now, but what happens next quarter and what happens the quarter after that? And with all the changes we're seeing globally, especially with China, China's a really big wild card right now. A lot of things hang in the balance for how they manage their COVID policy and what's coming. So, basically the Western side of of the globe, as we call it, the Western side, we got the COVID stuff the worst, right, early, and now it's like Asia's the one struggling now after the fact. So as long as that's the case, I do think that's going to keep upsetting supply chains. It's going to keep dragging out recovery. But if they do better than expected, then perhaps the economy can do a lot better too. But we'll see. Inflation has to come down. That's like the biggest thing. If we can't do that, then it's all academic. As far as what we're talking about now, it's not going to matter.
Yeah. All right. So we'll keep an eye on some of those reports coming out later this week. Obviously, the ECB Fed and our Fed next week. But as we mentioned early on in the show, it is earnings week.
Yep.
But before we run through some of the earnings news and do some a stock analysis, I do want to invite everybody to grab a demo of the Madison Trading House software. Mike will be going through it, but it's really got a ton of tools that allow you to analyze and make decisions. I know that a lot of people have referred to it as a cheaper version of a Bloomberg terminal. Now, I don't know if that's a good thing or a bad thing, but I'm going to say that's a good thing because a Bloomberg terminal is like $2,000 a month, right? Something like that. So if you're getting this as much bang for the a fraction of the cost, then I would seriously consider taking a look at the Madison Trading House software, grabbing a demo. I'm going to go ahead and leave a link to grab that in the comments. And then at the same time, we're going to go ahead and invite anybody that has a question about a specific stock to go ahead and throw it in the chat. And if we have time, Mike will run through it. But the big news of yesterday, basically, let's just go over here, is Netflix, right? And
Yep.
so Netflix, part of Fang. I was actually surprised that they rallied, considering that they lost subscribers, but they lost a less amount of subscribers than anticipated. What are
Yeah.
you seeing, Mike?
That's exactly it. And it's funny because yeah, they were expecting. They said they were going to lose 2 million subscribers, and instead they lost 1 million. So it's less of a loss, which is good because that means they lost half as much revenue as they expected to lose. That's always a good thing. Um, they did actually show better earnings per share than what was expected. They came in, I think, 3.32 or something like that. $3.32 versus 283. I think that was the number, but don't quote me on that one. But I think it was 280 versus three something. Um, the the reality with Netflix though is if we look at it, let's pull it up on the chart.
I mean, they're up 7% today. I'd say that's pretty good reaction.
Oh yeah, it's good. It's a good reaction for sure. So looking at Netflix, the main things we want to keep in mind on this, and this is a stock that I definitely have been asked about many times since the decline. Everyone's asking the question, should I buy in Netflix now? When should I get in? When should I get in? Well, keep in mind that Netflix did beat on earnings per share on some of the biggest declines that we saw. In other words, the estimate for earnings per share was 82 cents on January 20th, and they came out at 133. Then the estimate was 292. They came out 353, and then the current one estimate was 290. Sorry, and they came out 320. So that was close. But the reason I'm bringing this up is this: the earnings per share part is fine, but really what people are looking at is user growth. And it's the fact that Netflix had vastly less user growth than they anticipated, which is why the stock price has come down so much. Again, this is a lesson for those of you who are newer at stocks that expectations are what drive stock prices. So if people think that the company is going to be gaining a lot more subscribers at a faster pace, they're literally trading the value of the stock that they think is going to be worth in the future. Now, they're basically trading the future revenue they think the company is going to get. They're trading the value up to there. But when you change your projections of future revenue as dramatically as Netflix did, this is the result. Now we had to find where the bottom was. Now, so far, this is the first time that we see what looks like a true recovery rally. We've seen a few before, which kind of look like they might be going somewhere. But in this case, after earnings, we're actually breaking away from the upper recent range that the stock has been in. So let me scroll over. There you go. So we break out right here. Now, that doesn't mean we're going to keep going. But what's important about this is what Netflix looks like is happening here is that they're getting, since they didn't lose as many subscribers, that puts them in a better financial situation. So that does justify a higher stock value since they didn't lose as many subscribers as they thought. And they're still expecting to gain subscribers. That's a given, but they're just not expecting to gain them at the same pace that they have before. Now, one other thing to keep in mind is they forecast that they're going to add 1 million subscribers in the third quarter. We're currently in the third quarter. So when they report for this quarter later in the year, they're going to tell us how that this quarter went. And they're basically expecting that by the end of the quarter, they're going to add a million subscribers. The analysts on the street believe that they're going to gain 1.8 million subscribers. So Netflix is providing guidance that is well below what the analysts are expecting. We'll see who's right, but at the end of the day, in both cases, it does still say subscriber growth, which is good. It's just not at the pace that they were gaining before. So Netflix looks like it's in a decent spot right now for a rally to commence, which we already see part of it. It's just a matter of whether or not they're able to continue to see some growth in users that is good enough to justify a higher price. Now, I can't make a projection where this is going to go at this point, but I will tell you this: based on what the analysts are saying, we have 283, 23 as the median target, the mean target. The lowest target is 157. I don't see that happening. I really don't see 157 happening unless they something crazy happens, like maybe they have some sort of boycott or something. But that aside, Netflix should be able to hit this target, 283, in the next 12 months or so. So that gives us a lot of upside potential. So where we are now looks pretty decent. Now the highest estimate is 730. I don't see that happening at all. I think basically whoever estimated that is thinking about the past, but you never know; anything's possible. So it does have good upside potential. So far, the numbers still look fairly decent. They still have good revenue growth over time. They are losing net income. That's again one of the bigger factors that's hurting them. And if we look at their earnings forecasts, they look fairly okay this year. It looks like it's going to match up to last year, but 2023 is being projected to be a little better. And we're going to go over, by the way, how to read this later. But the point is, once we have the analyst expectations, once we have the earnings expectations, we can make some decisions. And based on my analysis, this looks like a stock that's worth giving a shot at this price range. And even if it doesn't go anywhere for now, longer term they'll probably be fine. I don't think that Netflix is on its last legs, as some people are suggesting. I just think that right now they're going through a difficult period where they have to reorganize their business model. But including they're talking about adding extra fees for people who want to share their membership, which I don't think is going to be a massive revenue generator, but I do think it will generate enough that it's worth doing. And also, they're talking about adding some commercials. All these things can help. I mean, I think if done it the right way, because a lot of the services I've seen, like Amazon Prime, they actually have commercials that come in. Like if you go to Showtime or something, you'll see a quick ad first, very quick ad, like maybe 10, 15 seconds, and then bam, they go right into your show, and you never see another commercial. I don't think most people, including myself, really get that offended by that. It's not that big of a deal. And if you really want to, you can pay to get rid of it. So I think they have room to monetize more of their users. And if I'm using Netflix and I just get like one commercial here and there at the start of a show or something, or at the end of a show, I mean, as long as it's not in the middle of it, I'm not going to complain too much. That's just my opinion, but
Yeah. The
I'm
the
sure they
other
can
thing
figure out even more clever ways of doing it.
the other thing that I don't think they brought up in this recent earnings call is they're getting into gaming. So that's a
Yeah.
entirely new sector that hasn't
Yep.
even come to fruition, but it could
Yep.
elevate some of these numbers, like you say.
Yeah. Yeah, I think they have a lot more room to still grow. I don't. I mean, I've seen companies on their way out, like AOL took forever to finally die. Just to put this out there,
Yahoo,
Yahoo took forever to die. so, so Netflix is still bringing in
Netscape,
subscribers. Yeah, exactly. This is a paid service, and people are still paying for it, including myself.
yeah,
And
and
I've
they're
never.
global.
Yeah,
They're global.
yeah, so I mean, for what everyone makes their comments like, "Oh, this Disney Plus and everything." Okay, look, I get that there are other channels out there, etc. But just because they're more things doesn't mean like one is going to take over everything. We'll just have more services, and that's what we're all like. Me personally, I'm subscribing to more things than I ever did before. It used to be just Netflix and Amazon Prime. Now I got this. Now I've got that. But it doesn't mean I'm getting rid of Netflix because it doesn't cost that much. So why would I be that concerned about it? As long as it gives me enough value to pay whatever $20 a month, why do I care? I'm not. I mean, I'm not
Well,
even
it's
looking at
getting
that
rid of the
bill.
linear. It's getting rid of the linear, and Reed Hastings, I think, did mention. I saw a couple blurbs that he's like in 5-10 years, it's going to be
Hmm.
watching your NBC News is going to be almost like non-existent.
Agreed.
So we'll see. The only thing that maybe draws some red flags here is that inner circle that's super red there.
Yeah, well, I don't. Let me. I guess money flow actually is positive, and this is one thing you got to be careful with the inner circle. When the inner circle is red, it's showing us the overall score based on everything. But remember that institutions, when they make their moves, we don't really see what happened until after it's happened, but we can see it in the money flow, and the money flow is definitely in the green. So we know that someone's buying this stock, and it's not just today. This has been over the last. This is tracking back since the 14th. So we know people have been buying since July the 14th overall. So my guess is that we're going to find out sometime later that Fund X, Fund Y bought more shares in Netflix, and then all of a sudden these institutional numbers are going to change. So for now, I would just say I look at the fundamentals first. We do look for this for timing, but the way I would see it is if I would like to see this in yellow, but I already see this in green. It's just post earnings. I know that's going to take a little time for us to see what the institutions are doing, but based on the numbers, I would say if you buy it right now, it's reasonable. If you want to wait, that's reasonable too. That you don't have to jump into this right now. And if this has any legs at all, we're only at the very, very, very beginning of it, and I'm sure we'll get another chance to get in somewhere near the prices we're at now. But for those of you who are parking money and you just want to get in and just not think about it for a while, now probably is not a bad time. So I feel comfortable enough with it to say it's something I would say without question if someone asked me, "Hey, would you buy Netflix right now?" Sure. This is not a bad deal. I'm probably going to put out an alert for the members for this pretty soon. But I usually do them in a very specific set of circumstances so everyone always knows why. This one's fairly close to what I need. It just basically all I'm going to do is look for a slight, and I mean very slight, retracement. It doesn't have to be a lot, just a little tiny retracement. We'll get in, and that's it. And if I can't get it now, I'll just wait for the next one, and then we'll get in then. But this one's definitely on the radar for a buy entry, and we'll see how it works out. But I do think the worst has passed for Netflix for now, and we can basically look forward to the potential of better prices later. We'll see, but that's the way it looks. Our downside risk is a lot smaller than our upside potential, so I'll always go for that.
Awesome. So we'll definitely keep an eye on Netflix. I agree with a lot of what you're saying there. Personally, I feel like HBO Max has come a really far ways in terms of their platform and their content. So I'm sure they've stolen some subscribers, but you're right, they're not going to go away. Moving on to our next name, I believe this is one that came up on your radar because I have never heard of this company, but Academy.com, Academy Sports and Outdoors, ticker symbol ASO. I had to go to the website, and I mean, they just looks like a normal e-commerce brand here.
It does. So yeah, I found this on our scanner. So I went to find scans, and I went to the score, and it was on this list. I don't know if it's still on today, but it was on this new stocks list for all green. So I don't see it here today, but it's in the list of all green. So if I go to sorry, the score, all green current, it should be in here somewhere. ASO, I actually don't see it. So maybe it's not all green right now. Let's see. Should be, let me find out if it's still all green. I think it is. Oh, okay, because the inner circle went yellow. Okay, so it was all green yesterday. Now the inner circle, something must have happened in there. Let me see. If someone did something, no, still up. So something in here changed overnight that caused this to go to yellow. But yesterday it was all green, and I think the day before it was all green as well. But that's how I found it. So this is a really good profile, however, because I'm ignoring the technical part for right now. It's good that it has a good technical score, but the valuation is very solid. We got pretty much everything is good except price to cash flow. So we have good price to book value, good alpha beta, good PE. I'll ignore the projected price for now, simply because I don't think it's really relevant. This is what I'm looking at here: the projections from analysts. The lowest projection, $50. The median is about 55. The highest is 72. So basically, we've got some downside potential, sure. But if we look at the target prices that are set by the analysts, we're actually below that. And this is a newer company, so we don't have a lot of history here. That's the only thing I don't like about it. The history is fairly short, but in the time they've been around, they have generated some decent numbers. Now, profitability is not there yet. Their profit margin so far is looking negative. Um, I mean, sorry, it's positive, but it looks like it's losing some steam there. So I don't think that's their fault, though. I'm guessing that they're losing profit margin due to economics that are happening for everybody. So in other words,
Supply
yeah, I could look at
chain.
Amazon's numbers and they're not going to look much better, as far as their current situation. So any company that looks like it's already profitable, it looks like it can generate some more profits. It's been generating earnings that have been exceeding expectations consistently. So if we got that, and we have some decent forecasts of future growth, not a bad idea if the stock is currently trading at a price point that seems to be fair. And at this point, it does. So yeah, this showed up on the scan. Now the breakout we're seeing right now in price is pretty aggressive. We've been seeing it rally basically from 34 bucks on the 5th of this month to currently is at 41.78. Now, if we look at this score down below, we can see that it's been in solid green multiple times along the way. So all these places where we see green, 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 like here, here, and here, this stock basically has had multiple times where it's been in all green. So if that's the case, then that means that this is not, something that just came out of nowhere. I do remember seeing this one before, but it's only recently that we've really seen this momentum pick up. So I do think this is a good stock to look at. I can't say I'm totally aware of all the details about what would make this company competitive versus others. But if we look at the metrics on the dashboard, it does have some good stats. It has 22,011 employees. So this is
Wow.
not a one man shop. This is actually some place that has some workers, has options. It actually paid dividend. The payout ratio is 4.3%. So this is actually a business that's paying out cash for, per share, which is unusual for a newer company to say the least. So I would say, in short, this doesn't look too bad. This look a company that has some potential. I did check out their website too. It actually, when I was looking at it, I was about to buy some stuff from there. In fact, I'm pretty sure I will because the equipment or the shirts and everything, their pricing is actually very good compared to a lot of other places, and the selection is actually better curated in my opinion. Because one of the things I always hate about Amazon is like they have so much stuff, and you have to take forever just to find one thing you want. Whereas this one seems like they actually took some time to figure out what they want on their platform, and they're only presenting the things that make the most sense. In my experience, Amazon is Amazon. They're always going to have their niche, which is we got everything. And you can find it if you really know how to use it. And everyone knows how to use Amazon at this point. But for newer comers, I would say you don't want to go that route. You want to go with more targeted market, a more curated market. And these guys seem to have done a good job with that. So this one looks like a solid buy. Obviously, we have to see how they perform over the years, but so far this would look like a decent shot because it's not like a fly by night company. It has a very good, solid base of employees. It has a good history. So I would say, yeah, this one I
A-
would consider for sure.
And just real quick,
Hmm.
what's the fastest way to find out when their next earnings is from this
Okay.
view?
Okay. Well, there are
Just
a
because
couple.
I'd be curious now, right? Like it's greens all across the. So when's the next time they're going to be, giving updating investors?
Okay. So there are two ways. The easiest way is if you're on the stock, you go to your dashboard, the main view for the stock. And then down below, you have days from now for earnings. So I'm under the EPS tab. So this tells me how many days from now, 50. What's the date? Thursday, September 8th. Now, of course, we don't know what the EPS is going to be yet. So that's why that's in three dots. But other than that, these are showing us the estimates that we have presently, $2.12, and the trailing 12 months of actual earnings, $6.97. And if I want to go into more detail, I can click on that earnings details button and I can see all the history of everything that's happened for their earnings, actual, current. So this one is the next one that's coming, just to be clear. So this one hasn't
September
happened yet.
8th, right?
Yep. And
September
this
8th.
is the last one that came out. And those are the results we have for that one. Right. So it's fairly simple, very simple to find that. Looks like there's a pretty good gap here between that's
That's
about
what I
6 months.
thinking.
Yeah, so maybe I guess they must have, yeah, because it says Q. That's weird. So it's almost like they skipped an earnings, because here it have, yeah, there should have been an earnings in June, but it doesn't look like they reported it for some reason. So I'll have to check. Maybe they did, but for some reason the data is not available. But as far as I can tell, the next earning, well, I know for sure the next earnings is coming in September. That's a guarantee, but I'll have to see if there was maybe a missing. Let's see. Yeah, it
Well,
was not
either
available.
either way, I was just
Yeah.
curious to know
Yep.
the easiest way to identify that because we are in earnings season and it can move a stock, when those
Right.
reports come out. Um,
Exactly.
so with that, let's go into our feature of the week, which is kind of touching on that topic of earnings history, um,
Yep.
and forecasting. So what specifically are you wanting to educate some people that are on the fence about using the software with this feature?
Okay. So one of the things that I love about the software, the way it's set up, which our guys have developed, is that we are keeping track of all of the earnings and forecasts and the changes in forecasts, and that's in this box right here. So in one box, you can actually get a full summary of the earnings history. So instead of me going to something like this, which we still have, where I can just read what the results were, or if I go and Google it and say, oh, what were the earnings for Netflix? Let's just make this easier, right? So the easier way would be just to show the history. So this is the quarterly history. Earnings come out once per quarter, but we can also track the earnings totals for a year, the fiscal year. So right now we're looking at quarterly. So this is showing the results that came out for September 2020, December, March, June, etc. Right? And these results show me two things. The line in the middle shows me the actual outcome, and the shading in the background represents the estimate. Now, if the shading in the background is green, that means that it was an estimate, a positive earnings per share. If the shading in the background were red, like we see here for Boeing, that means that the expected earnings per share was expected to be negative. They were expected to lose money. The line in the middle, of course, if it's green and pointing up, it means that they had a positive outcome, actual earnings. And if it's red and pointing down, dark brown and pointing down, then that's a negative outcome. So what the line means is if the line is longer than the shading in the background, either going down or up, that means that the earnings were worse than expected in this case, much worse than expected in that case. This is way worse than expected. They were expecting to lose $1.78 per share. By estimates, they lost $15.25 in reality. Over here, a similar situation. They were expected to lose 9 cents a share. Instead, they lose $7.69. So these are massive negative results, surprises. And if we're looking at Netflix, we have, for example, this one here in September 2020, the estimate was that they're going to make $2.13, but instead they made 174. So since this line is inside within the range of this shading in the background, it means that they were short of expectations. It could also happen, although we don't have an example here. Sometimes you can actually have an expected of a positive earnings, but instead you get a negative earnings. And if that were the case, you would see a green box here, and you would see a red line pointing down below by whatever the distance that the earnings went. So the line would have one result, and the rectangle in the background would have another. Notice in this little graphic that appears next to my mouse, it has the dark green color for the estimate and it has the light green color for the actual. So that's just letting you know what each one means. So here we had a positive surprise where we beat earnings expectations. Same, excuse me, same thing here, 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 and here. And if I go to a yearly, here's what we can learn. So 2014, Netflix underperformed expectations for earnings. 2015, they barely beat expectations. Then they basically matched expectations in 16, matched expectations in 17, matched expectations in 18, beat expectations in 19, basically fell a little short of expectations in 2020, exceeded in 2021. And as of right now, we're waiting to see how this year will go. So these boxes on the left, or sorry, on the right, that are in blue shading, these are future projected earnings. And what these are based upon are estimates that are derived from all the analysts out there. Now, for those of you who don't know this, there's an experiment that you can do at home if you ever want to have some fun. Put a bunch of marbles in a jar, bring a bunch of friends over, let's say 20 friends. You all look at the big jar of marbles. Each one guesses how many marbles are in there. If you take the average guess of all the people, usually the number is going to be close to the actual number of marbles that are in the jar. This is just something that's been tested for decades. So what this means for us is that when analysts, if you have a lot of people watching a stock and you do have a lot of people analyzing Netflix, the average estimate probably is going to be close to the reality. So the average analyst estimate for earnings is probably going to be close to right over time. You're going to have surprise beats, you're going to have surprise misses, but averaging overall is probably going to be right. So right now for the year of 2022, expectations are basically current. Their estimate is that Netflix is going to end the year with $10.68 earnings, and that's what that box on the left of my mouse over here, that's what that number 10.68 bottom is saying. But we also have these boxes to the left of it. And what these are tracking what the estimates were before versus where they are now. So if we went back 60 days ago, estimates were that Netflix was going to hit $10.96. That's the top number. The second number down is 30 days ago, what people were expecting. Then we have 7 days ago, and finally we have current. Now, what I like about this is that since it's showing me how those estimates have changed, I can see which way people are adjusting their estimates in. And it's clear for Netflix, they're adjusting them down, which means that expectations have been consistently lowered for Netflix, but they're not lowered by a huge amount. The slope of the decline of the estimates is fairly it's clear, but it's not like a massive drop down. Compare that to, I think Amazon would be a good example. But let me see. Now, this is by the way, Amazon, since they did their split, we're going to have to adjust these numbers because they're based on the per share basis. Since Amazon did their 20-for-1 split, it looks like they're not expecting Amazon to have any earnings, but that's because we haven't adjusted these numbers to reflect the split. So in short, if we saw, I'm trying to find a stock that has a good example of this. Well, here's Boeing. Not a really extreme change, but you can kind of see that for Boeing, 2022 numbers have been adjusting downwards as well. They've gotten more negative. So if we saw a really big drop right here on the current versus what it was 60 days ago, that means that things are really getting bad for the company, that people are seeing real problems and they're dropping the estimates as a result. Also, here you can see for Boeing as an example for 2019, you have this green estimate for positive earnings, but instead you have an outcome of negative earnings for the year. So this was a big negative surprise. And a lot of times these are the precursors to what we see in 2020 and 2021, where you have a company that when you have these big surprises, everyone's expecting to make money and you lose, then that usually means that things are a lot worse for the company than what everyone expected. And usually stock prices will plummet after this happens because everyone finally realizes that things are not as good as they seemed. So, in short, using this information can be very helpful, but also bear in mind that you also need to know what people were already expecting, which is why we have all this other dashboard information. We track what the earnings estimates, are saying about the company. And for Netflix, all that happened here was not that they lost money. All that really happened was that we don't have the big expectations of earnings anymore because of what they said themselves, which they basically announced towards the end of 2021 that they're not expecting to make that much money. So the estimates were already lowered, and here we are now. So this is a very good tool. I use this a lot. In fact, most of the decisions I make are based on how the earnings look on this chart, amongst other things. But this is one of the primary deciding factors, in addition to the targets that are set for the stock. So if I notice that the earnings are slumping, a company's got earnings that are all over the place, like Boeing, I'm not buying that stock because, yeah, maybe I want to hold something long term and hope it goes well. But unless I'm seeing a consistency in the earnings, either they're consistently the same or they're growing, that's not going to be a good idea to get into. So you always have stocks that don't show a lot of growth, like Apple. Apple earning fairly flat, but Apple is so well established that what do you expect? They're just going to keep crashing in money year after year after year. The only thing you worry about with Apple is if they're going to stop making money, which so far they still look fine. So growth on Apple is not going to be nearly as impressive as what we'll see for other stocks, but they're going to be consistent. And if we can find a consistent stock, maybe we invest into those and just let it grow very gradually over time. But if we can find a stock whose earnings are growing quickly and they're consistently beating expectations, that's a stock that we should find attractive. So for this one, although they don't have a lot of history, the history we do have, they've been beating expectations. And since that's the case, and this is also the case if we look quarterly, they are consistently beating expectations. Quarter after quarter after quarter after quarter, they're beating and by good margins. So this is a winner. This is a company that's really, kicking butt and taking names. So therefore, that's the sort of company we want to keep an eye on because it does show the best growth potential.
Love the feature. There's so many features in the software that we could go on for hours about their how to read them, the value. But if anyone is liking what they're seeing on the screen, feel free to click that link in the chat, download a demo. Someone from the team will give you a nice little walkthrough. But there's certainly a ton of information here to help you become a better trader, a better investor. And so, I highly recommend everyone check it out. I know personally, since I've started using the software, when I think about something that I hear in the news or whatnot, I tend to want to go to the platform to get these like blurbs of like, okay, well,
Yep.
like, the news is this, but like what's the reality? And it really does save time. And the color coding and all that. I love it, and I'm looking forward to seeing it evolve, and looking forward to seeing about the new features and things like that. So thank you for that thorough run through, Mike. I think we're getting close to our limit on the show here.
Yep.
um any final words and any words of wisdom you want to leave anybody with, midweek?
Not this week. Again, there's not much to watch, so just we'll see what happens. I'll definitely keep my eyes on Netflix to see how they proceed. Also, another name to keep an eye on, I would mention, is Starbucks. I'm not going to get into it right now, and ASO. Those are two. Those are the three stocks I would say watch the closest over the next week as they proceed, and see if there's a way you can find your way in.
Yeah, let's talk about Starbucks next week, because I know there's a lot of things in the news. So with that, if you've enjoyed the broadcast, feel free to hit that follow, hit that like, hit that subscribe button, and we will do our best to provide you with more content every week. Michael, thank you for your time, sir.
Thank you as well, and thank you everybody.
All right, everyone.